Many of us look at the S&P 500 or the Nasdaq or many stocks and we believe everything is up. We believe there's no opportunities in the market. But I'm actually seeing more opportunities that I've seen during bear markets because the divergence between AI and non-AI stocks is getting absolutely ridiculous. There's tremendous opportunities in this market. I'm going to talk about two growth stocks that I own in my portfolio. I told you guys about Outstore. It's up 120% year to date. But I also have other growth stocks that haven't been doing too well, and I'm going to talk about them and give you my thesis and why I believe they're presenting pretty amazing opportunities. So I really hope you enjoy it as always. The first one is Constellation Energy, ticker symbol CEG. It's down 16% over the last year. I started buying it at $155 in 2024, and I've been averaging up over the last year or two. Constellation Energy is a utility company in the United States, unregulated utility company. They have a pretty valuable nuclear fleet. The nuclear fleet is very, very valuable. It cannot be rebuilt. It cannot be replicated, especially the legacy reactors, you could say. Now they're trying to build those SMR, small modular reactors. They're not going to be built before like 2029 or 2030 or 2031. And they're not as powerful as old reactors, which are pretty much impossible to replicate. So they have some pretty amazing assets. Constellation Energy is so big that it provides about 7.4% of the US electricity supply. So if, let's say, Constellation shuts off, 7% of the entire electricity supply in the United States will be gone because it's supplied by Constellation Energy. So this is more of a national security asset, you could say. It has a moat, physical moat. You can't replicate those nuclear stuff. And it's a pretty good company in general. It's a bet on AI, actually, because AI uses a lot of electricity. Electricity prices have been spiking massively in the United States since 2022, since we had ChatGPT. They've been spiking like crazy, and people have been suffering from higher prices. And we have many more of those data centers coming up, as you could see here in this pink area. Pretty much by 2030, data centers in space is not going to happen anytime soon. And I still believe it will be more efficient to do it here versus space for at least the next 10 or 15 years. So Constellation Energy is not going anywhere. But the hyperscaler, again, they're desperate to secure power. The Oklo kind of SMRs and the Bloom Energy kind of turbines are not enough. They need actual powers. So they supplied the deals with Constellation Energy, like Meta secured a 20-year deal for Constellation Energy to supply them with electricity. Same thing with Microsoft was restarting a old nuclear plant. They're gonna restart it. It's gonna be coming up online very soon, and they're gonna also provide power to Microsoft's data centers for the next 20 years. So this is a very beautiful business model. But the reason why I own the company and the reason why I like it very much is because it's an unregulated utility company. So a regulated utility company like Duke Energy or like AEP, American Electric Power, the government, you could say, or the local municipalities, they pretty much dictate how much they're going to grow in earnings per share. They can only increase prices so much, maybe 5%, 6%, 7%, whatever it is. Constellation Energy is guiding 20% earnings per share growth for 2029, every single year until 2029. So the growth is massive relative to the regulated utility companies. Now, there's a few reasons for that. The first one is they have the nuclear tax credits. The nuclear tax credits gives them a floor on how much they can charge on prices from now to 2032. So they have the tax credits. It gives them a minimum of a floor, you could say. The floor is about 13% earnings per share growth. But recently, they signed long-term agreements with Meta and Microsoft and so many of them, and that's helping boost earnings per share growth. So now they're guiding 20% annually until 2029, which is pretty amazing for me. But I think it could potentially be even higher than 20% because it doesn't include higher inflation. So if inflation was 3% instead of 2%, that would add 1% to the CAGR. So it would become 21% growth. Now the CPI is like 3.8%. So we're going to get about 21% this year. Then it also doesn't include share repurchases and other investments. That adds another 2%. So now you have 23% CAGR in earnings per share growth from 2026 to 2029. I don't know any other company that's providing this kind of guidance. So it's pretty amazing. Now you may be wondering, if this company is so amazing and it's a bet on AI and bet on all these things, then why is the stock going down? And to be honest with you, I don't really know. I mean, it's really crazy to me that we had such a rally in semiconductors, a rally in AI, and this used to be treated as an AI stock. It's not being treated this way, and the stock is not participating despite the company executing on a major scale. Okay. Now, if you remember, I showed you the 3 Mile Island, which is supposed to be restarted for Microsoft. They said it's not going to be restarted before 2029 or something crazy. So Constellation Energy applied for a waiver to restart it earlier. The waiver was recently approved, and the stock went down anyways. So now there's a very high chance that it could potentially be reopened in 2027, and that's not included in their 20% guidance. So there's some uncertainty around this as well. Something else that happened recently is a lot of the shareholders from the recent merger that they did with another company, they pretty much want to sell out. So they're doing a secondary offering of about 11 million shares. The stock went down a lot on this news after it was starting to go up. And it says Constellation is not selling any shares. So it's not dilutions, they're not selling any shares. But those big investors, they want to get out. Okay, and they're not going to receive any proceedings, but in fact, they actually offered to buy 2 million out of the 11 million shares. So they're going to buy back 1% of the company in this transaction alone, and because they believe the stock's undervalued. So again, I look at all these things, I look at Constellation, and I look at what the narrative is, which is that they're going to be putting in price caps on Constellation. But that's not going to happen. The president said that the hyperscalers will be paying those prices. It's not Constellation, because if they put price caps on Constellation, they will be discouraging supply. And we desperately need a lot of supply in the United States. So I show you this company, they have a physical moat. They supply 7.4% of the entire electricity of the United States. They have, again, the nuclear tax credits, 23%, 24% earnings per share growth for the next 3 to 4 years. Well, what do you believe the stock is trading at? Well, it's trading below its growth of about 21 PE. So I'm expecting 23, 24% earnings per share growth. It's trading at 21 PE. And I believe the stock's undervalued. And I don't know for how long it's going to be trading at 21 PE. Now, again, people look at utility companies, they say, oh, but Duke Energy is trading at 17 PE. Duke Energy is growing 6% in earnings. This one is growing 20, 23, potentially 25% in earnings. You can't really compare a regulated one to an unregulated utility company, especially if it has a nuclear fleet, because the nuclear fleet commands a premium because you can't really rebuild it. This is extremely valuable asset, guys. So I believe, again, it's undervalued. I don't know for how long the market is going to keep selling it versus AI. This is not just an AI bet. They power about 11 million homes. So this is just a boring utility company with some growth, and I believe it's more than fairly valued at the current price. Now, the second one, which a lot of people hate, is Robinhood. Robinhood is only up 10% over the last year. Year to date, it's down like 28%. This is by far the most explosive stock that I own. I would say maybe Ouster is explosive, or Mama's or SoFi, but Robinhood by far has the most catalysts I have ever seen, and it's not even close. Now, very recently, an insider from Robinhood, he purchased 15 million shares. The week prior to that, he purchased about 20 million shares. So this is about $31 million worth of shares combined that he purchased over the last 2 weeks. Whenever you have an insider buying up $31 million of a company that has such high stock-based compensation, that tells you maybe he believes it's undervalued, or maybe something's about to happen. But we all know Robinhood, and we know how popular Robinhood is. But I'm sure you'll be surprised to know that Robinhood's market share in equities, in stocks, in the United States is only 1%. So imagine how much you know Robinhood and how people are familiar with it. They only have a 1% market share in equities in the United States. In options, they only have a 7.5% market share. In crypto, they only have a 1% market share, guys. 1% in the United States. In terms of margin in general, they only have a 1% market share. So if you believe the growth is over, you have to think about it again, because they can easily take 2, 5, 7, 10% market share in equities. I don't see why that's not going to happen. And that's just the United States. We're not talking about Canada, where they expanded. We're not talking about any other regions that they've been expanding into. So the business has long runways, despite the company having 27 million people. I think that's maybe mainly in the United States. Okay. Now, historically speaking, the company was very cyclical. It was very dependent on crypto revenues and options revenues, but that's not really the case anymore. As the company is expanding into areas where it's not as cyclical as pretty much just crypto and all these speculative stuff. For example, they expanded in retirement accounts. Retirement accounts, you could say it's like a passive bid, the passive revenues for Robinhood, where people are going to be contributing, they're going to be getting payment for order flow, and it's a good revenue stream, stable revenue stream for Robinhood. It's up 50% year over year. It's been a steady climb in terms of the accounts in general, but they also have been expanding other products such as the Robinhood Gold Card, which I personally have, and people are still on the wait list. This one has been a massive, massive success. And the best part is Robinhood is not taking the credit risk. So if you're not paying the credit card or whatever, Robinhood is not taking the risk. A third-party bank is taking the risk. Robinhood owns the platform, they own the ecosystem, and they own the banks. They pretty much take on the credit risk, and Robinhood pretty much collects commissions and volumes and other things. They also did Robinhood Banking. This one's up crazy. I also have Robinhood Banking. It's a pretty amazing product. And they have Robinhood strategies for people that want their assets being managed by some kind of a sophisticated strategy. But they also expanded into the professional traders or active traders in general, mainly on index options, futures, and event contracts, but mainly futures. And this is important because a lot of experienced investors, they trade futures if the market's going up and if the market's going down. So that also adds more and more resilient revenues to Robinhood. And the testament of that was their latest quarter, where in Q1 of 2025, they had 252 million of crypto revenues. Now they have 134 million. They have less than 50% than they had before in crypto, yet they grew 7% year over year. So despite the company declining so much in crypto, they grew 7% year over year, largely due to other revenues. Now, the other revenues, it's partially Robinhood credit cards, it's partially Robinhood banking, but it's mostly the event contracts or things with like Kalshi and Polymarket. This one has been growing like crazy, and I think it will continue to grow. And this is a big catalyst that's coming up for Robinhood is actually the World Cup. So as people want to bet on the World Cup, they come to the United States, they might download the Robinhood app and bet on a few things. Even from Europe, I think they have the Robinhood app as well, and they might decide to bet on sports or maybe on the World Cup using the Robinhood app. They also have the pattern day trading, where you couldn't really day trade more than 5 day trades a week if you have under 25,000. But Robinhood's average account is like 12 or 13,000. So that unlocks more and more trade for the company. You also have all the IPOs coming up where people are signing up for Robinhood to get SpaceX IPO and get other IPOs with no minimum. So that's also bringing up more and more people. And there's just and Robinhood and the Trump accounts, and there's just so many catalysts. It's not even funny. Yet the stock is down 28% year over year. Now the stock was overvalued. It was trading at like 65, 70 times earnings. Now it's trading at about 40p. I believe 40p personally is not really expensive for the business model. The business model, the broker business, it's one of the best business models you can own. It's like you own the casino and they're playing in the casino. It's a pretty amazing business in general, very high margin business. If Robinhood wanted to maximize margins, they would have 40, 50% at income margins. But they're expanding more and more into development and research and marketing and things to grow the company. But it's trading at about 40p. Now, if we look at the growth that's expected, where Robinhood is expected to decline 9% this year in 2026. I really don't see how the company is going to decline 9% earnings per share when you have all those catalysts coming up. The pattern day trading, which is huge, crypto potentially bouncing back. Maybe it won't, but I think it will most likely will in the second half. You also have the World Cup. You have so many things coming up, Robinhood banking and all those things, and the IPOs, and it's going to decline 9%. I personally don't think so. So if that just reverses to what I believe it should be, which is about 15, 20%, and I've seen it happening before, I think the stock would be trading at about 30, 31p. So I believe 40p here is not really a bargain, but it's not really expensive for the company as it's pricing in a 10% decline earnings per share. And with all those catalysts, I truly don't see how it's not going to be growing in earnings per share, especially taking into consideration the April volume of funded customers and volume, how it has, you could say, improved in a major way, and May will likely be much higher than April. So I believe the stock's undervalued. I believe CEG is maybe more undervalued than Robinhood. It's safer than Robinhood. But over the long term, Robinhood has way many more call options than Constellation Energy. And that was my opinion on those stocks. I hope you enjoyed it. It was not financial advice. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.